Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. It's 10 o'clock, so we're going to get started. Just raise your hand if you can hear me okay. Okay, great. Thank you. Hey, Tom, good morning. So we changed some things with the lighting, so I hope, not that it was bad, but I'm just trying to always do things a little bit better. But just let me know. You can send me some input if things look too dark or I should make any changes. All right, let's get started here. So it is, as I said, the 12th of October. We've got many things coming up, but first, let me just remind you that you are muted. Q&A is available at the bottom of the screen. You type in your questions as we go, and I'll stop periodically and check to see if there's any questions and answer them as we go, or I might wait till the end, depends on where we are. Chat should be disabled, and as always, these webinars are recorded, and you should be seeing these on the website. I've showed you before how you can access those, but we have now dozens of videos up there for you, and you should be able to view those. All you have to do is put in your email, you can download it, and you get that information. We have some classes coming up starting next week. So starting the 19th, we're going to have 2 different classes. They're a total of 6 hours in 2-hour class period. So what I mean by that is next Tuesday on the 19th, we have a 2-hour class starting on the 19th that runs the next 2 consecutive Tuesdays. So 2 hours on the 19th, 2 hours the following Tuesday, and 2 hours the following Tuesday after that, which I think is November 2nd, which is election day. And then same series on Wednesday. So starting the 20th, 2 hours, 2 hours, 2 hours on Wednesdays. There's a lot of material. I've tried to condense it and do it different ways, and it's just not as good as of a class. So if you're going to join our class, you're going to be with us for 6 hours. Now, we've got a pretty full class. If you still want to join, you have the ability to do that. I sent out an email yesterday. I sent out one earlier in the week. If you've already taken a class, you should still have your workbooks, I'm hoping, because I'm not going to be able to send you new ones. They haven't been updated yet, so it's nothing new. The material is going to a little fresher as far as what's going to be presented to you, but the base material in the workbooks is going to be the same. So you're not really missing out on anything from that point of view. All right, so there are the classes coming up. So I added a section in here for headlines. And one of the big headlines this week is total non-farm payroll employment rose by 194,000 in September. And the unemployment rate fell by 4.4 percentage points to 4.8%. So the U.S. Bureau of Labor Statistics, that's where we get this information. They also report Consumer Price Index and real earnings and Producer Price Index, which we get all this week starting tomorrow. They report this information on a monthly basis. Notable job gains occurred in leisure and hospitality, and professional and business services, and retail trade, and in transportation and warehousing. Employment and public education declined over the month. So believe it or not, we still have a shortage of teachers, certainly in this area, but nationwide. And this is not a new thing. This is something we even in our area where I believe we pay our teachers quite well, really a lot of great benefits, we still have a hard time hiring qualified teachers. So this has been an issue, and many people don't believe that. When I tell people that, in Council Rock, the district, that I have about a month and a half left serving as a board member, you'll see I can't help but smile when I say that. We still have a difficult time hiring people, and people sometimes don't believe that. And maybe I wouldn't have believed it if I didn't live it for the past 8 years, but that is for sure the case. Tomorrow, as I said, we get the Consumer Price Index numbers, and at 8:30 in the morning, and that's what everybody's got their eye on, right? Inflation. Consumer Price Index is commonly known as inflation. And everyone's very, very concerned about inflation. Fuel prices, you've seen the price of fuel if you're paying attention, the energy and the cost of oil per gallon. I'm looking at the screen right now. It's $81.12. So that's jumped up significantly in a short period of time. Probably about where it should be. It's been really low for some time. Is the $81 a barrel? You know, if we start crossing over $100, $110 a barrel, things are going to be get much more challenging. But everybody's got their eye on consumer price index, so we'll have that information tomorrow, and we'll talk about it next Tuesday. So let's. We also get real earnings tomorrow. We don't usually discuss that. I'll just review that report from the Bureau of Labor Statistics and see if that makes sense to have that discussion. And then the following day, on Thursday, we get the producer price index. So we'll talk about at least the CPI, consumer price index, and producer price index a bit on Tuesday. So I talked last week, going into the slot reports, I talked last week about the proposed legislation that came out of the House Ways and Means Committee. So this is a subcommittee of Congress. Now, the entire bill has to be voted on in Congress, and this is where it gets very uncertain of where we're going to land. But we talked about the changes in the the conversion allowability in Roth IRAs, and I touched briefly on these mega IRA ideas. So what this bill is really targeting is what they're calling these mega IRAs, and that is anyone that has more than $10 million in an IRA. And I'm going to tell you in a minute just about how many folks in this country have more than $10 million in IRAs. So two big items: anybody with over $10 million in an IRA, and you can no longer do a Roth conversion if your taxable income is more than $400,000, or if you're married, if you're a single filer, and $450,000 if you're married. So the mega IRA works like this. It would require anyone who has a more than a $10 million balance in their IRA to take a distribution. So it would be a required minimum distribution, and it would not follow the same calculations that we use for required minimum distributions, which we're going to talk about in your planning section today. It is proposed to look like this. If you have $17 million, for example, in your IRA at the end of the year, you're going to have to take 50% of what's over the $10 million as a required minimum distribution. So that would be a $3.5 million distribution. And then there's a separate mandatory distribution rule for those with a total account balances exceeding $20 million. So this gets really, and these are IRAs. There are some exceptions to this. So this gets really in the weeds a bit, and this is all proposed, so I'm not going to spend a lot of time on it. What I want you to understand is that this is what Congress is focusing on, and these are the fringes we've been talking about. They're going to try to find different ways to increase revenue on these fringes, and this is a fringe play on this, and I'm going to have that information for you in a moment. So it's not going to produce a lot of revenue. There's not a lot of people in this country with over $10 million or $20 million in their IRAs. You know, your average folks are really, really fortunate if they have $5, $6 million in their IRA. That's a big number in IRAs. The average people we see, they're coming in with, you know, $1.5 million, $2 million in their IRAs, and that's a lot of money, and a lot to contend with with making those tax efficient. Now, certainly we have folks who have much more money, much more than, $1.5, $2 million, but I'm just giving you the average. And I see people with less than that, obviously, in their IRAs, and that's a whole other issue. We're talking about where the attack is, and I'll call it an attack on assets now, not just on income, but on assets. And how that's the thought process is about getting tax dollars. It's not a political statement at all, because these deficits that we have to be funded. one thing that's certain, whether Republicans are in office or Democrats are in office, no one's taking their foot off the gas as far as spending. Spending continues to increase. So we've got to fund this somehow. So these fringe steps, like taxing IRAs that are above 10 or $20 million, like reducing the ability to convert funds from an IRA that are, if you make more than $400,000 to $450,000 in taxable income, they're starting to say, okay, how can we increase the revenue in the most popular way? And the most popular way is let's tax the rich first. And you're clearly considered rich if you make $400,000 or more. That's kind of where the bar has been set. Or if you have more than $10 million in your IRA. Those numbers have to level down because it's not going to bring enough tax revenue. So we start with the idea that it's just going to be a $10 million. And then at some point, it's got to level down. Does that become $2 million, $3 million, $5 million? I don't know. This is what Congress has to work on over the years, because this is probably going to be something that's going to change over time. There's going to be some kind of resolution on this proposed bill coming out of House Ways and Means. And then once that's established in law, then they can jockey the numbers every year, increase them, decrease them, however they want to do it, just like they often do with the estate tax. So we're always at a risk of, right now, for a husband and wife, the combined estate tax exclusion is over $22 million. There's a lot of discussion about that coming down significantly. So right now, that estate tax portion of it is probably off the table, but that's going to be a discussion next year, and it's going to be a discussion the following year. And it's likely that all these numbers are going to come down and really focus on that middle class. And in the next decade, as you know, all of my studies and the group I work with, we believe that the average middle class American will be paying 40 to 45% in effective tax within the next 10 years. So that's why we work so hard with efficient tax planning. So this is this article from the Ed Slot. This is from Ian Berger. He's one of Ed's analysts. So from his group, this focuses on now that there is this potential law out there, people are starting to talk more again about defined benefit plans and other ways to avoid building up large sums of money in an IRA. These are positive steps and things that are already on the table that people use now. There are pros and cons about defined benefit plans. And that includes what are called cash balance plans. But from a tax efficiency point of view, they make things more challenging. So when we get into starting to set up these defined benefit plans, which many people like to do because they're pretty expensive to run. They typically generate high fees or high commissions for the financial person who sets them up for somebody, and the attorneys involved. You typically maybe always have to have a lawyer involved. So these defined benefit plans can get pretty pricey, but there is a value. You can put a lot of money away. An older business owner, for example, can put up to $200,000 away in a defined benefit plan, as compared to about $64,000 in a defined contribution, like a typical 401k plan. So, and you can use those together. So it can be very interesting from that point of view. Just be careful. So one of the things that I'm going to remind you of is your team. I'm going to talk about your team that you want to work in with your tax planning and your financial planning. And I mention these defined benefit plans because many people read these things and then suddenly say, oh, you know what? I got to do that. I read about this. I had a client who's been with me a long time, and we were doing a review call. She lives in Philadelphia, and she's been with me since the Wachovia days. And she had a question about her estate, and she said her friend told her that she needs to put her house into a trust and to avoid she told her the opposite. She said if the house is in the will, then it doesn't go through probate. So she had this completely backwards. Anything that's in your will has to be, unless it's a very, very small amount, it's referred to as a de minimis amount. it has to go through the probate process. So this woman who's in her 80s was getting advice from a friend of hers, I think literally at the hairdresser's, and it was all backwards and wrong. So she said, well, I don't know. I'm going to go back and have to tell her. And I explained to her, I said, listen, you've got to rely on the professionals, not your friends who may mean well, but maybe read something in an article or heard something from somebody and maybe they have it backwards. Don't make big changes based on an article you read or what your, cousin, brother, uncle, friend told you. Let's check in with your team and make sure that we're looking at all the different options. Okay, so we're going to talk a little bit about now non-spouse beneficiaries. This is an important one. So in this letter, and this goes to Sarah Brenner, the question was this. So this is a financial advisor who had been, he's not a member of Ed Slott's group, but he attends some conferences here and there, and he reads Ed's emails. So he wrote in, I'm a longtime subscriber, having met and talked with Ed at several industry conferences going back well over 20 years. Which with all of Ed's great work and active networking puts me in a pretty big club, he says. In any event, a CPA has turned to me with a problem. So this financial advisor has a CPA that he works closely with, and a client of the CPA's passed away earlier this year with $1.7 million in her IRA. Her estate was the beneficiary of the IRA. Her 80-plus-year-old siblings are the beneficiary of the estate. He says, I know, not great facts, but it gets worse. The CPA consulted with the executor and the broker who handled the account. So obviously it wasn't this advisor's account. It was some other advisor who had a relationship with the same CPA. So the CPA consulted with the executor and the broker who handled the account. They all agreed not to do anything until hearing more from the CPA. A few weeks after that, the broker and the executor decided to liquidate the holdings in the IRA, even though the estate IRA was never opened. They then sent a check to a bank account for the estate, which is, of course, a checking account, not an IRA. I am told the IRS regulations prevented the state from rolling back into an IRA. Is this true? So Sarah writes back, thanks for your support over the years. Unfortunately, the news here is not good. The rules are very strict when it comes to non-spouse beneficiaries, such as an estate and rollovers. Once the distribution from an inherited IRA is paid to a non-spouse beneficiary, it is irreversible. It cannot be rolled over or put back into an IRA. Only a spouse beneficiary can roll over a distribution from an inherited IRA. We see this mistake far too frequently, and unfortunately, there is no fix. Yes, this comes up at every conference. So in 2 weeks, maybe even next week, I'll be spending, unfortunately, over a webinar, 2.5 days with Ed and his group. And we're going to go over things that happened since the last time we all got together 6 months ago. And there is inevitably, maybe even this case is going to be in there, but there's almost always something like this, where somebody takes a distribution from an IRA without really spending the time to wait for a proper response or even seek a proper opinion about how best to do it, and they just act quickly. I think I may have shared with you that I'm working with someone right now that is getting a lot of pressure from the people that have current funds of her deceased husbands. And I told her, just do nothing. There's no rush here. Let's figure out the best way to do this. And we're working through the best way to do it now. But here's a situation where this is completely irreversible. $1.7 million is going to be 100% taxable this year. And that could have easily been avoided. So these things happen all the time. And you just pause, get your team together. And if you don't have a team, reach out to us. We'll put one together for you. But you get your team together and figure out the best way and be patient. There's no rush here. If you need funds, that's a different story. You can distribute a portion. You could do, there's different things that you can do in that interim, because that's a reality too. Sometimes you need funds immediately. And that's something that can be resolved. But I've never seen it where it's necessary to do a full liquidation unless there's very, very little money there. There's no need to do a full liquidation just to get temporary funding. All right. So the next the next question is a really good one too, and this has to do again with inherited IRAs and RMDs, required minimum distributions. So we know that when you reach age 75, or you're a non-spouse and you inherit an IRA, you have to take required minimum distributions. Well, under the old law. Now the current law is the 10-year. You have until the end of 10 years. But there are plenty of people, even clients of mine, collecting required minimum distributions that from an inherited IRA, and that has to continue. So the question is, I have a question about clients who have inherited IRAs and need to take an IRA for 2021, but did not take their 2020 RMD because of the COVID RMD waiver. So last year, 2020, you weren't required to take a RMD waiver. Well, they use the life expectancy number they used for 2019 RMD and subtract 1 or subtract 2. I'm going to explain that in a moment from that number to account for the skip 2020 RMD. Well, the answer from Sarah is, she says they're getting many questions about this, how to calculate the RMDs for 2021. There's a lot of confusion in the wake of the 2020 waiver under the CARES Act, but here's how it would work. A non-spouse beneficiary who is required to take RMDs based on life expectancy would subtract 2 from the factor that was used in 2019. Even though no RMD was required for 2020, it's still counted when determining life expectancy factor for 2021. So what the heck am I talking about? This is confusing, and it's something, this is another area where people make big mistakes and it can be costly from a required minimum distribution point of view. So I'm going to share my screen with you right now once I find my setup. Hi, Gerard. It's I think you've asked this before. So Gerard's asking regarding RMDs, is there any talk about revising RMD calculations to higher percentages for everyone? So we're going to see in a moment that it is not percentages. There's a divisor factor, and I'm going to show you that. And yes, there is a new RMD table that's supposed to come out. It was supposed to come out, I think, 2 years ago, and it's been delayed. So what we're hearing now is it's going to come out next year. And this is a life expectancy table, so we expect it to be obviously longer. So let me share with you. Let me just close out that question, and let me share with you the RMD tables. So I'm going to share my screen, and what you should see is my whiteboard. So raise your hand if you can see my whiteboard that says uniform lifetime table right now. All right, so you're going to see me looking down because I'm going to be explaining. I'm going to be drawing on the board here. All right. So this is uniform lifetime table, and this is what you use for your own required minimum distributions. So we know they don't start now until age 75. So let's go to age 75. And I covered up my notes. So let me go back here. And let's assume that the year-end value, so if we're doing 2021 RMDs, required minimum distributions, we use the year-end value of 2020 year-end value. And let's assume that that is $1 million in your IRAs or IRA. Remember, you have to count everything. IRAs can be aggregated. 401k plans and retirement plans cannot. So let's just say that everything you have is in IRAs or an IRA, and it's $1 million. And you're using uniform lifetime table because it's your IRA or you inherited from a spouse. It would be your IRA anyway if you decide to roll it in there. But for whatever for these purposes, it's your IRA. Now you have to take a required minimum distribution. There is no percentage. It is this factor, life expectancy in years. So that's the factor we use. So we don't multiply it by a percentage. We divide it by 22.9. And I know because I did the math earlier that requires a required minimum distribution of 43,668. So that's if it's your own IRA, right? We divide this total, $1 million, by 22.9. And then you can see every year that amount goes down. So I didn't do this math, but I'll do it right now. If you still have $1 million in there by the time you're 80, right? So at age 80, it's still $1 million. I'll just do it real fast. But the factor is going to be what? 18.7. So Maybe somebody can do this in their head, but I can't divide things in my head. So that now is 53,475. This is one of the things we're concerned about an future tax liability, because IRAs, they tend to just increase. We certainly have times when they're down, but over time, over that 5-year span, it's likely, even with distributions, that you're at least going to be the same, if not higher. So so that's important. So these are your own RMDs. Now, what happens if you inherit an IRA? So this gets tricky, because the first mistake people make is using this chart. Well, for an inherited IRA, that's a no-go. You can't do that. You have to use a different chart. Now, these charts are available on my website. You go to attleborowealth.com under the slot corner, because these are Ed Slot's charts. I want to give him the credit for them. Under the slot corner, you scroll down past the videos and the picture of me and Ed, and then you can find these charts and download them. So my big dog is right outside my door, and you might hear some barking, and I apologize if that happens. But for an inherited IRA, we use a different chart. And this is simply named, make it green again, single life table for inherited IRAs. So it's really simple if you had the charts. It does get a little complicated though. So let's use the same age. So at age 75, let's find 75. I'm here in the middle. You see the factor here is 13.4. Well, that's going to be different, isn't it? Let's use that same number, that $1 million in the IRA. We divide it by 13.4. Well, that is $74,000. Right, so first of all, that's different. So if you use the wrong chart when you're calculating your RMDs, and people like to do this stuff on their own, and I don't know why, but let's talk about the difference. 74,626 minus, I didn't do this prior, 43,668. That's 30,950. So if you did it wrong, the difference, it's the sign for difference, is 30,958. Well, if we fail to take that, sorry, hold on a second. If we fail to take that, we know the penalty is 50% of what you should have taken, or 15,479. So what often happens though is this isn't discovered in 1 year. When you're do-it-yourselfer, you tend to do your taxes yourself and everything else too. But you might do this for 5 years, let's just say. So you're gonna end up multiplying this difference by 5 plus growth, and you're gonna end up multiplying this penalty plus times 5 plus growth. So that's a big concern there. So that's mistake number one. Mistake number two is people say, okay, well, I did that one. So let me just clear up this so we can see the next one. Okay, I did that one. Now next year, $1 million. Let's just say it's the same year-end value. So here's 2020. And the end of 2021, you got the same $1 million, just for the sake of ease here. Well, you might say, okay, oh, I did that one. Now I'm 76. Now let's do 12.7. Now I learned this. I read this somewhere, divided by 12.7. Now I got to take 78,000. Oh, that looks right. It's a little bit more. And I've taken my RMD. Well, you didn't do that right, because actually what you do is, this is what Sarah was just talking about, because the question people had was, well, if I didn't take my RMD in 2020 because of the CARES Act allowance, I'm erasing the wrong thing. Then they said, should I subtract 1 or subtract 2? So what are they talking about? You don't just go to the next age. You actually have to subtract 1. So here's your factor. We determined the factor. It is 13.4. So that's what we have to work with. That's the year that you inherited the IRA. Now, listen, I'm using 75 just to keep it at the same age to show you the difference. But you could be 58 and inherited that IRA, and you still have to take if we're working with prior law, now it's 10 years, and I know that's confusing too, but there's still a lot of people that have these inherited IRAs, and there could be people listening that have done this wrong. So what we do is we don't go to 12.7 here. If you're taking this distribution now, you got to subtract by 1 every year. So this factor is going to be 12.4. Well, 12.4 is a little less than 12.7, right? So the RMD is going to be more. $1 million divided by 12.4 is 80,645. So you've created a difference there of $740, $1,900, and oh boy, hang on, let me find the whiteboard again. Okay, sorry about that. There's a difference there of $1,900. So then your penalty, of course, for that would be $952. So that's really, really common. That simple mistake. So the big mistake is using the wrong table. The second mistake is not figuring out the factor correctly. You can try to do these things on your own, but it is very, very challenging. And these rules are easy to violate, and you think you're doing it right. You read something in a magazine, you heard something, but you can see that it's easy to make that mistake. All right, before I move on and talk about the markets, are there any questions about that? Okay, good. I hope that was helpful. I know that's a confusing issue, but it is important to address. So let me just go back to planning for 1 second. And this goes back to my discussion about your team. Remember who I say that your team is. Your team is, I think it should be, you should have a certified financial planner. A financial advisor with a lot of experience is fine. You know, the certified financial planner designation is a tremendous amount of work and really is the gold standard in the industry. There are requirements each year. There are ethical requirements. You know, it's something to take very, very seriously. This is a serious job. You should take it seriously. So I think obviously as a certified financial planner that everybody should be working with a certified financial planner as a baseline. You know, my feelings about the EdSlock group, there's just 400 of us in the country. And that number, that always astonishes me that, you know, this is what I just showed you is what the things that we learn in the EdSlock group. How to determine the correct table to use and how to calculate those required minimum distributions and be correct about it. And those are important things because I guarantee you that the majority of the people who aren't in the 400 of our group don't know about that. The other member of your team is a qualified CPA. And yes, I believe it should be a CPA for all the reasons. I think your advisor should be a CFP, but I think you should have a CPA and at least you're one attorney. You may have multiple attorneys. You may have an estate attorney, an elder law attorney. They might be the same. If you have a business, you might have a business attorney, you might have a real estate attorney, but you need at least one attorney. And those three individuals or multiple individuals should be working to figure out together what's best for your situation at any given time. So that team is vitally important. Okay, let's talk about the markets. So last week, ending October 8th, we had some positive growth. So the Dow Jones Industrial Average was up 1.2%. The S&P 500 was up 0.83%. NASDAQ was up a little bit, 0.10%. And everything except really the world small cap was down slightly. So small companies was down 0.11%. The 10-year treasury jumped to 1.61. Week before it was 1.46. So that means interest rates went up a bit. And that's just what we're seeing right now is a lot of volatility in interest rates. And as you've heard me say, that's challenging. As you know, so far this week, well, yesterday was a down week. Even I think Friday was, I think Friday we closed down, but we still ended up with a positive week overall. We haven't heard from MFS lately. They have a new representative who just started sending out this report again, and they have this by the numbers report. And I'm going to read some of the items in there. So this one talks about inflation. Then this was interesting to me when I read it. So I'll just read this to you. After adjusting numerical data from the past for the impact of inflation, the U.S. median household income reached an all-time high for 4 consecutive years, 2016 to 2019. Now, pre-pandemic, right? Peaking at 69,560 in 2019. The streak ended in 2020 when median household income dropped $2,000 approximately to 6,000 or 67,520. Before 2019, the peak for median household income was 63,000. So that's just an interesting tidbit of information. 63% of American households surveyed in August this past year made a large purchase in the previous 4 months. So people are spending money, including large household outlays for essential activities, housing related, and large expenses for non-essential activities like vacations. So that comes from the Federal Reserve Bank in New York. How about just, we hear a lot about unemployment and wages and how things are, we went out to dinner, my wife and I on Friday night went out to dinner maybe 2 Fridays ago. I don't remember now. Yeah, it was 2 Fridays ago. So I may have shared this with you already. But the owner of the restaurant was the one who was waiting on us because he can't find any help. He's saying he would pay $20 to $30 an hour for just a bus person. So for every $1 spent for wages and salaries in the private sector as of June, employers paid an additional 45 cents on benefits, including paid leave, insurance, retirement plans, and legally required benefits. Average private sector compensation is $29.48 per hour, while the cost of benefits averages an additional $13.12 per hour. Really interesting. Everyone's kind of concerned about this talk about shutdowns, and there's some past information in this report. There have been 21 government shutdowns in history when our nation's lawmakers failed to agree on spending bills to fund government outlays for a fiscal year that begins annually on October 1st. The most recent shutdown, a 35-day stoppage that ended on January 25th, 2019, was the longest closure in history. 11 of the 21 shutdowns lasted 3 days or less. That comes from the Congressional Research Service. We talked about the bill that came out of the House Ways and Means Committee, and they talked about this, and the headline on this is "You Have Too Much." That's interesting. The House Ways and Means Committee, the Tax Writing Committee, and the lower chamber of Congress passed legislation on Wednesday, 9/15, that would force Americans who have retirement accounts balances greater than $10 million to take an annual minimum distribution that would be taxable and prohibited additional contributions to the account. The bill still has to pass the full House and Senate before going to the president for a signature. So we know about that now. How many folks, I told you I'd tell you this, how many folks have these mega IRAs more than $10 million? Well, in 2019, there were 3,625 American taxpayers who had $119.5 billion in mega IRAs. So this is what I'm talking, and that means pre-tax IRAs that had balances of $10 million or more. That the Congress knows this, the country knows this, the IRS knows it, because I don't know when this started to be required, but now you get a form every year that tells you exactly how much is in your IRA at the end of the year, and so does the IRS. So this is what I'm talking about the fringes. So when you have 3,625 Americans who have IRAs greater than $10 million, you can see that while that's going to generate some tax revenue to force all these folks to take a portion, a required minimum distribution of half of any balance over $10 million and then be taxed on that, it's not going to move the needle as far as the money that we need coming into the federal government. It's going to help for sure, but it's not going to solve the problem. So we all know that taxing the rich isn't the answer, the complete answer. All right, here's some information from BlackRock. BlackRock is talking about 3 key points this week, and just the headlines. They think there's a low risk of government default. There is the discussion about not every year, about not increasing the debt ceiling. It's always, well, we're going to default. We're going to default on our bonds, on the treasury bonds that are out there. And BlackRock thinks there's a low risk of default. We believe the debt ceiling dispute will eventually resolve, but it could trigger more volatility. The broadening economic restart keeps us tactically pro-risk. U.S. job growth, they say, slowed sharply in September, but we see it as unlikely to affect the Fed's taper plan. We talked about tapering several weeks ago now, and that is just slowing down, issuing bonds, buying them back, really putting money out into the system. The Senate reached a deal on a temporary temporary debt ceiling rise. And the week ahead, the U.S., we talked about this already, the U.S. inflation data will be in focus as price pressure has appeared to be more persistent than expected and broadened beyond pandemic-related items. And I have to give BlackRock credit. I think they were the first analysts, certainly that I follow, that started to talk about inflation early, I would say summer of last year. They said, look out, inflation is coming, of 2020. All right, folks, it is 10:40. We covered a lot today. We talked about the markets. I gave you some ideas that I read from the analysts. We talked a lot about what came out of the Slack group. That tends to be a good chunk of our conversation every Tuesday. Let me know if you like that. We added that maybe, I want to say 3 or 4 months ago, but it's probably could have been 6. There's a lot of great information there. And then for our planning discussion today, we talked about your planning team. You want to have a qualified CPA, qualified CFP, and at least one qualified attorney. There's a lot to deal with as we're in the middle of October already. We're deep into, it feels to me, deep into the fourth quarter. I know you're probably saying, well, Mark, it just started. It feels deep to me. Your year-end tax planning, we've got to look at your income. I met with a client last week that had the largest bonus that he's ever received during his many, many years of working with this company. So we were unable to do Roth conversions for him this year. We have to know those kind of things. Your team should know this. So your income, distributions from retirement accounts, Roth conversions, past and planned, capital gains. We're starting to get information from investment companies about capital gains distributions from mutual fund for the year. And then plan contributions, your IRAs, your 401ks, your Roth. Any updates to your estate issue, or your estate plan, anything like that are things that we should be discussing now at the end of the year, because once the year passes, once the ball drops 12/31, there's nothing we can do. There are a few things we can do for 2021. With that, I'm going to say good day. Hope you all have a great day, and we'll see you soon. We'll see you next Tuesday. And don't forget, the classes start next Tuesday night, next Wednesday night. If you're going to sign up for the class, I ask you to commit for the full 6 hours. We do have a limit because we have a limit on textbooks that we have. So we're gonna put a kibosh to that pretty soon. And we'll see at our webinar next week. If you need to schedule time with me, my calendar is going to populate when you log off. And let me just do a double check for questions. I'm sorry I didn't do that before. I got to find you guys again. All right, no questions. Have a great day, everybody. Thanks for always being here, and thanks for your feedback. I really appreciate the feedback that you send, and I'm hoping you continue to get a lot of great information out of here. Have a great day. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.